Welcome to another short video on assigned risk plan of USA Insurance.
What is assigned risk in the USA? Well, let's just dive right in. Picture this for a second. You're a driver who's hit a patch of really bad luck. Or, maybe you just made a few bad choices behind the wheel. You absolutely still need to drive to get to work, run your errands, the whole shebang. But what happens when literally no standard insurance company will take your calls? Who actually covers you then?
So, looking at the core insurance problem here, let's say you are that driver. You've racked up multiple speeding tickets, maybe a couple of at-fault accidents along the way. Eventually, you're just flat out rejected by the regular voluntary insurance market. And it's not always just about your driving record, right? Insurance might even turn you away for a really poor credit score or if you're involved in hazardous activities. But here's the kicker. You legally have to have insurance to drive. So when every single company is telling you no way, where exactly do you turn?
Well, the answer is the assigned risk plan. You might also hear it called a residual market plan, or sometimes a high-risk pool. Basically, this is a state-established system designed specifically to provide insurance coverage to individuals or even businesses who just cannot get it in the standard market. It's essentially a state-authorized lifeline. It's the ultimate solution that allows our difficult-to-insure driver to legally get covered and finally get back out on the road.
But, as you might guess, there's a catch. A pretty big one, actually. If we compare the standard voluntary market versus the assigned risk plan, the differences are huge. In the standard market, you get broader options, standard deductibles, the works. But with an assigned risk plan, you're going to face some incredibly strict limitations. We're talking restricted benefits, way fewer coverage options to choose from, and significantly higher deductibles across the board.
And then, of course, there's the cost. As our sources point out, premiums for assigned risk plans are generally higher to reflect the increased risk associated with insuring these individuals. Look, it all boils down to the math. If you've got a history of accidents and a glove box full of tickets, your statistical risk profile is just much, much higher. Insurers literally have to charge those steeper premiums to offset the very real likelihood that you're going to file a claim down the line.
So how exactly do insurers handle it behind the scenes? Well, these plans are authorized directly by state governments. And here's the fascinating part. Standard insurance companies operating in that state are actually required to participate. There's no opting out. The state essentially takes all these high-risk policies and assigns them out to the insurers proportionally, based entirely on their market share. So everyone in the standard insurance market ends up taking on a fair slice of that high-risk pie. Ultimately, this acts as a crucial backstop. Assigned risk plans serve as a really necessary societal safety net, making absolutely sure that everyone has access to essential coverage.
Thank you for watching the Quick Bite series.